It's time for the markets. We do this every Monday with our partners, Forsyth Barr. Joining us today is Senior Equity Analyst Matt Montgomerie. Matt, good morning.
Good morning, Ryan.
Good to see you. Good to have you here. So let's talk markets. Fonterra, well, how could you go past them? And that result last week, and the payout for shareholders.
Yeah, talk of the town. So FY25 result was last Thursday. They reported normalised earnings of around 70 cents per share, so above the midpoint of their guidance. If you wind the clock back 12 months ago, they were guiding to 40 to 60 cents, so quite a good year in the context of where they started. They've obviously announced the completion or the near completion of the Mainland Group deal, so plenty happening, and they capped off FY25 in a very solid position. And the markets like it, obviously, and the talk, at least from some farmers, is that this is going to be the new normal, that they could continue this kind of winning streak that they're on. Yeah, possibly. I mean, I think it's important to remember Mainland Group has been roughly 10 to 20% of their earnings historically, so it's a big change and it's a big number, the 4.2, but it's not a dramatic step change. But I think, as you alluded to, or as Garth alluded to earlier, it does create a couple of risks around greater exposure to commodity price cycles. The ingredients and food service businesses, which is what Fonterra is left with, is inherently volatile, largely with factors outside of their control. It does concentrate more exposure to China. But the first glimpse that they did provide into the business without Mainland Group was reasonably positive, ahead of what we were expecting. So the first runs on the board have been solid, but for now it's about, I guess, proving up the change in strategy. And there is, because Garth was talking earlier about the risks that have been identified with the sale, as you say, leaving them more exposed, that sort of thing. But there were also risks and downsides to having it too. Yes. You know what I mean? Yeah, no, I think that's right. If you look through the history of the consumer business and the Australian business, it's been reasonably underwhelming for not just 1 or 2 years, but a considerable period of time. So, naturally over time we expected that business to improve, which was a driver of growth for Fonterra. But we're of the view that Fonterra has made the correct decision here in divesting the business, and we're supportive of the price is reasonable. Okay. And what about Synlait? They've got a report coming out today. Yeah, so 8:30 this morning they'll announce their full year result. It's been reasonably well guided, but there are a couple of key questions here for the company moving forward. One is around how they manage their North Island plants. So they're quite meaningfully loss-making. The plant's reasonably underutilised, so the trajectory of that will be interesting. Plus, the A2 Milk Company, which has been their large, successful company for a considerable period of time, is slowly navigating themselves away from Synlait. So any commentary as to how Synlait is preparing themselves for this move will be of interest.